What if you could learn in weeks what it takes the average hedge fund analyst years to learn on the job? What if you could stop guessing at what your PM wants from you or how you should be spending your time and instead feel confident you are putting your efforts in the right direction? If you want to accelerate your buy side career, the Analyst Academy from Fundamental Edge will give you the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. The Fundamental Edge Academy is taught by a veteran hedge fund analyst and PM, Brett Coffrin. Brett teaches a practical approach informed by his years of experience at some of the top funds in the world, such as Maverick Capital, D. Shaw, Citadel, and Schoenfield. Wonder how top long-term funds approach earnings season? That's covered. How will your PM expect you to add value in the first year on your job? That's covered too. Worried about what makes a good stock pitch? There's a whole module on idea generation and thesis communication. Plus, you'll get access to the Fundamental Edge alumni community, a highly engaged community which in just 1 year has grown to over 400 investment professionals. Fundamental Edge alumni get access to exclusive webinars, case studies, and an invite to their first annual Analyst Spring Training Conference in Arizona. If you want to fast track your buy-side career, go to fundamentedge.com for more info. That's fundamentedge.com.
All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, also the author of YetAnotherValueblog.com. Mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on for a repeat appearance, one of the people's favorite guests, Judd Arnold. Judd, how's it going?
It's going great, man. Going great. Great to see you. Great to talk to everybody.
You look incredible. You compare this year to last year, the before and after. Let me start this podcast the way I do every podcast. Quick reminders to remind everyone, nothing on this podcast is investing advice. Please do your own work. Consult a financial advisor. Always true, particularly true today because Judd and I are... Go ahead. Oh, I thought you said something. Always true, particularly true today because Judd and I were talking before. We're going to go through the offshore space. We're going to go through some specific offshore names. We talked about 4 or 5 names just off the cuff before. So we'll be going through a lot of names. Just remember.
Let me add a little disclaimer. I have to add a disclaimer too. I got more lawyers. So some or all the securities we discuss may or may not be suitable for you. Investing in the stock market contains risk, including risk of loss. Everything's for discussion purposes only. Consult an investment advisor before making any financial decision. Do your own work. Some or all of what I say may be wrong. All right, we're good.
Look at you. Who's the host? Who's the guest? Anyway, Judd, the reason we wanted to have you back on, A, because the people are always demanding a repeat appearance, but B, wanted to just quickly start by going through, re-going through the offshore space. Almost exactly a year ago, you came on, you and I did a long podcast going through all of the offshore space. It was a real example of alpha because you specifically said, despite how many times I asked, what about Valaris? You're like, no, Tidewater is the best play. Tidewater, they're the shortest cycle, the best management team, all this sort of stuff. And I tweeted out before a chart, Tidewater's up 60% over the past year. XLE down, Valaris down, RIG down, SPY up 20%. But, that is a real example. So I just wanted to start by asking you, let's go through, early 2024. How are you looking at the offshore space in general right now?
I now segment it a little bit more granular. I think Tidewater's in a world of its own. I think it continues to be the best one. I think a lot of our thesis has proved out. I think the things I would emphasize even more, the shareholder alignment with Rabadi on the board and the management team being incredibly shareholder friendly I think that is massively played out and underappreciated. They're going to do what is right. Now, we may have a commodity cycle move against us. We may have a lot of bad things, but I think that's big. I think the cost of capital and access to capital, which was a question, has really played out. The bond they did, it was a 5-year bond, non-call 2. Maybe it's not call 3. Came out at like 10.25% or 10.5. I think that's trading at like 7-8% risk right now. And I think what you're playing for now is they have a really restrictive Norwegian secured debt piece too. It was issued in Norway or something. I think you're going to see a full refi there. I think you're going to see the ability for those guys to issue all in debt, debt capital at 7-8%, maybe 9 at the worst, which really gives them a nice way to continue to roll up the fleet. You saw buyback, max buyback this year. The working capital is really going to unwind as it always does every year in Q4. So they're going to show a very nice cash balance. And I think in terms of competition, this is another thing. It's not just that it's short cycle. I'll get to the rigs in a sec, the offshore rigs in a second. You look at the top 10 OSV guys, and most of them are still very much wounded man. So the ability for Tidewater to come in and keep rolling up the space at attractive prices. It's not enough. We saw how many times we see this in energy. Great, we're rolling it up. Oh, awesome, you're paying. And that's not great for me. Like, But if they can keep buying, decent boats at 15 million a boat, even 20 million a boat, when yes, they're 10-year-old assets. And another part of the call is that I think these 10-year-old assets are going to run for 40 years in total. So you still have 30 years of duration, which is different than the last cycles where you had new build and whatnot, early retirements. I think you're going to see all assets, not just OSVs, but rigs. You're going to have 30 more years of duration, which all else equal for the finance geeks out there, you do a single ship or single rig DCF. You start at year 10, you add the extra special surveys. If you think that thing is done at year 30, you're kind of, I think it's about a 14, 15% unlevered cost of capital. That means you should pay fair value about 5 times EBITDA in year 10. If you think you get another 10 years, that gives you another, 3/4 of a turn to a turn that you can pay today. So it's kind of nice. And the math I do on Tidewater, new build economics, I think it's, a $25 a share free cash flow story. Stock's now, about $65. I think you go through new build, and I think it's playing out. And I think you're going to end up between buybacks, dividends, and whatever you want to call it. I think you end up, with a standard deviation of probably $25 to $50 a share, one way or the other. I think you end up at $200 of value for Tidewater through the cycle, and we'll see.
Let me ping in a few questions there, right? So number one, and I've asked, look, right before I had you on, I had Quinn on to talk about Tidewater, right? Or just the space in general. I love the roll-up story, but one thing he's always emphasized to me is like, at some point you get diseconomies of scale on this business, right? It's not Facebook where you can have every user on the planet on your, and I kind of wonder if after the last deal, if we're at the point where I do hear you on, there are sellers here, but after the last deal, are we at the point where, hey, you can't add any more boats to this or else it becomes inefficient?
Possible. And I think this goes to Quinton and it goes to Rabati, that's a really hard question. And I think Quinton and Rabati, I just trust that they're going to be thoughtful about it. The debt's a really good weapon and they have the ability to do it. And if they think that is better served with buybacks, we're still at 15 million bucks a boat is what you're paying for this darn thing. So half of this, half of the other, I think they're thinking about it all the right way and they're going to be incredibly shareholder aligned and they're going to do what's right.
Okay, next question. I've listened. I remember texting you in, I think it was October, when you did a Twitter space and you were just like, look, we're talking at some point. Now, this was more on offshore rigs, not that, but we're talking share of economics and it all applies to Tidewater eventually. But one of the things you've consistently emphasized, look, if you can't handle a 50% drawdown in these, and maybe this applies to every stock, but specifically these, you shouldn't be in the sector. These things are designed to be a little bit traded. You take a view, but you want to trade around them. I guess my question to you would be, I started, hey, Judd, alpha call, up 60% a year. Anyone would love a stock up 60% in a year, right? But all the peers were flat or down, and yes, they're loose peers. Why is it now where you and I should be saying, alpha call, this has been a big run, pull back, oil's come down to 70. None of the peers have really run. Yes, they did some great deals, all this sort of stuff. But why aren't we sitting here talking about, hey, let's trade around this, let's reduce, let's wait for the next pullback? Does that make sense? And that's more tactical than I think I ever say anything on this podcast. But as you said, these are terminal assets at some point, right? The boats 100 years from now are zero or a scrap value. So you do kind of have to trade around. If this was 600 instead of 60, we'd certainly be trading around. But what do you think about people who would say, hey, Tidewater was the winner? You need to be kind of looking at the other names right now.
I think that's fair. Generally, it's a fair comment. I think we got involved with Tidewater, starting high teens and 20. And at that point, I was completely macro. I was like, I don't care. You can blow up the world and I'm not losing money. And we're now, all these things, you got a lot more eyes on them. We're deeper in the sector, we're deeper into the cycle. You are exposed to macro, you are exposed to micro, you're exposed to all this stuff. And the sizing that you can get and the convexity that you can get is way less. And I think that's certainly something that you need to fade rallies a little bit. These things are all going to be, you think of a train going from the Acela from Boston to DC. People get on and off at every stop. And who's to say that they're right, they're wrong? There's a lot of space for a lot of people in these things. And I think I go a little bigger picture than the company specific. And I think this is really a portfolio management decision, which is, for me, there's a size. Okay, there's what I would trade and what I would own. With what I would own, there's a size that I want to have throughout this cycle and how it plays out. And everybody's going to have a different number there. And some may have a number of 0. Then who's to say that those people are wrong? Not the core call across all of them is that I think that we are still in the very early innings of a long cycle. And these things are very difficult to trade when they snap back. You typically have a really big snapback in a couple of days. So I think there is a reward for taking pain, so to speak. But there's a lot to be said. Like, I mean, I'm sure we'll talk about RIG in a second. You look at all the hot money in RIG. It's a very liquid stock. You got day traders. You got all vol jockeys with the converts. You got all sorts of stuff going on there. And when the RSI gets elevated, all of the above.
I hear you, because I'll disclose I had a position in Tidewater. I have a position in Tidewater, but to me, as you said, they could announce a deal and the stock can go up 15% on the day in the good deal, because most of the deals, all the deals they've done have been great, and the stock market's kind of picked up on that. But, I probably traded this too aggressively. Like, it got strong, but the story was so good that it's so cheap. Like, if you've just got that long-term view, I don't know. Is Tidewater still your way to play this?
Yeah, I'd say Tidewater is my number one. And like when I tell people, look, I'd buy all the Tidewater. If you want to play the space, Tidewater is my number one. Pick your number. It's much more liquid now. We were talking about this a year ago. Some of the biggest pushback I got is like the thing doesn't trade. It was a $20 stock, and if it traded 500,000 a day, you're like, wow. So I think liquidity's gotten better. The distressed guys have gotten out, but there's still look, it's also OSVs and all sorts of stuff. Then I'd say the bigger question for people playing this space is, I'll call it the big 3.5, and which is RIG, VAL, Noble, and then the half is Seadrill. Not that I'm besludging them, but look, you got some distressed tech guys in there. You got some holders liquidating.
And Diamond Offshore is just sitting over here saying, what do we have to do to get, we're just here for sale all the time for sale. What do we have to do to get into Judd's big 3.5?
Okay, well, look, Diamond, I would presume that people make money in Diamond if we make money across the rig space. I think the biggest problem you have with Diamond is your time to get equity is kind of gone, because you look at what that equity check would be from a big guy. And for Transocean, they're going to give up, 20, 30% of their equity to add a couple of rigs that are, your Transocean, you're kind of like, I don't need to do this. Why would I do an equity? This doesn't do anything for me. And I think you can say the same thing for all of them, save maybe Seadrill, but I think you're going to have this bid-ask spread. And if I owned 100% of the equity of Diamond, I would actually be going around taking a discount on my equity to get equity in somebody else. I think that's the long-term best. I'd do a no premium to a slight discount deal. I think that's the best way to make money over the long term. And that's hard. I just don't see how it plays out. But I get people who are there. They're going to route, we're excited that we have one BOP and a few rigs, and okay.
Let me back up, just because I'm worried we dove very deep, just talking specific deals. I do want to, so people who look at, me, total tourist, just looking at this. Now, maybe I'm besmirching myself because I have done quite a bit of work on the industry, but I look at Valaris and RIG, and both of them are down in 2023. And if you had told me by the end of 2023, we were seeing multiple rigs pricing at $450,000 day rates. I think some were even touching started with the 5. Now, it depends how you account for some different stuff. But if you had told me at the start of the year, we were going to be ending the year and just seeing every rig that was getting taken off going for 4.5, I would have said, okay, great. These stocks are really starting to work. And Valaris, RIG, they were both down on the year. And you had this, we should talk your suggestivism in a second. I think people got a little bummed out with Valaris's capital allocation towards the middle of the year. But, overall, I look at these and say, hey, the stories seem to be working out. And aside from Tidewater, none of the stocks are working out. Is this just a timing thing? Or obviously the market's a discounting mechanism? Is the market discounting something that I'm kind of not seeing yet?
I think the market corrected a previous, this is like a Buffettism, where there's an interview from in the 60s where it's the market's down 50%. And somebody said, is the market making a new forecast? And he said, well, maybe correcting a prior wrong forecast. And there's something to be said for that. So the way I think about it, there's multiple layers to this. Okay. And this is sort of people get on and off the bus, right? The people who drove, let's say, RIG up to $859, and just for math for people on RIG, at $450 a day terminal rates, you don't cover the debt. At $550 terminal rates, you're a $10 stock. At 600 terminal, you're like a $15 to $20 stock. It is.
When I first started looking at it, I was like, hey, I tell people I like Valaris, I like Tidewater, and a lot of people said, dude, if you like the sector, you just play rig. They're levered to the hilt, and if it works, it's gonna work. And this was when rig was like 3, to be fair to them. If it works, it's gonna work, and if it doesn't work, none of them work. So it's all kind of the same. It's very levered. It's very levered.
It's very levered, and I think so. You got a lot of people as the stocks start working; these become momentum plays. They always overshoot to the upside. I think the negative thing that played out for the year was, one, commodity prices came back a lot, and obviously it is really hard to make money in offshore. I mean, Tidewater notwithstanding, when Halliburton, Schlumberger, and Baker Hughes are down on the year, like you're in the oil services bucket. Like you're just not, like, you're always going to struggle because this is oil services beta times 2. So, or 3 or 4 or 5, whatever.
Yep.
Like it's a lot more. So I think there's that trading dynamic that the whole space, energy struggle. Energy is still the best performing. The XLE is the best performing sector on I think, and on a 3-year basis, 21, 22, 23. But you look at 2023, it was one of the only ones negative. As like, I think it's still up. The XLE, I think it's up 150% over that period. So I think you had a little bit of a consolidation. I think one of the things I misread in the moment was, certainly at the Barclays conference in September, a lot of the, managers were saying, we need to consolidate, rates can't really super inflect basically until the end of 26, or sorry, end of 24. We were in 23 because we still have, depending on how you want to count it, let's call it 10 to 15 rigs that are either stacked or stranded yard rigs that have to come in. And the fleet's roughly, I want to say about 180. So those guys, when you have a stack rig or a stranded new build, it's not really stranded anymore. If it's new build, we're putting it on the water. But you're all else equal, those guys are going to take a lower price on contract because they want to get term and they want to just get the rig out there. And that pricing dynamic, basically what the message was as time played out, I think a lot of people, smarted up to this, myself, sort of figured it out as well. Like, okay, we're like, if we end 24 at 550 to 600 a day, that's great. But we're not, I think we started 23 with the hope that this was going to like start really moon inflecting and it's going to be more linear and it may even be like a shallower slope. And we're just sort of, and then you interplay that with the contracting profile of all these assets. And you're like, okay, when am I going to eat, or feel or get the full earnings power, even if spot rates go to 550 a day? When am I actually going to see that in earnings? And all of a sudden, if you miss this sort of 18-month contracting window and you're stuck at 500, you're now all of a sudden you're saying, I'm going to get, even if rates go to 600 by the end of 24, I'm not going to get that until 27.
You're giving a very long and coherent answer to what you said. If I summarize like your original Tidewater thesis, hey, everyone else is long and it takes a really long time for these rates to flow through to them, right? Whereas Tidewater, they were coming out on their calls and they were saying the market's really tight.
7-month contract duration with Tidewater.
The market's really tight. We think it's going tighter. We're taking a bet. We're betting on ourselves, and we're going to stay short because we think rates have to go higher. And there is risk in that, right? If they were wrong and rates went lower, it's not great. But they were right, and as you said, this is why they're the best play, and that is why that is one of the reasons why they were the best play.
Yeah, I think now going back to the big three, we'll just exclude. I'm excluding Seadrill for people just because it's still a stock in transition in terms of ownership and portfolio. Like Rig, Val, and Noble don't have to buy anything, and I think what it is what it is. Seadrill, I think it's incredible. Like it's a smart management team, it's smart shareholders, but like there's clearly additional corporate actions that are going to happen. This is not what that company's going to look like in 3 years. With the big three, Rig, Val, Noble, I think I've had this question. It's both a question and prediction of Rig is clearly, round numbers. I forget where it is now. Let's call it round numbers, 400 million to 450 in offshore, a deep water asset. You have to like come with an assumption for the jackups, but like for the premium stuff, you're paying about 400. For Val and Noble, you're paying like Val is like 250, Noble about, 300. So there's this discount, and it sort of made sense, or at least I was rationalizing. I think other people were too. With Rig didn't file for bankruptcy. It's the one people know. It's the most liquid, and people are just comfortable with that one. And the other two have distressed debt holders, less liquid, blah 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 blah. Whatever. that discount should disappear as, but for the leverage torque through the cycle. And at some point, I kind of figured, look, if you're really right on this and you close your eyes for 5 years, that you're supposed to make the most money on VAL just purely based on math. Like you're getting the assets 40% cheaper.
I agree. And that is why VAL was my favorite of the offshore names, But there is, hey, if it works, like Rig going from 400 to 440 on their balance sheet versus VAL going from 250 to 450 on their balance sheet, you might make more on Rig, to be honest, just given the level.
Yeah, but like the counter to that, though, is like if you really get term at the top, you're going to get you're going to get the reverse effect of you're going to get a re-leveraging of VAL. I'm trying to think of what the word is. Rig, it's obvious that you have the torque. VAL and Noble, the torque is there. Like they're going to keep adding debt to do levered buybacks, and that's how you're going to get it. So once Rig's a debt play down. It's effectively a public company LBO of a rig company. VAL and Noble are like unlevered. You're going to get shareholder returns. Now, VAL, you also have ARO, which is the jackup subsidiary with
Saudi
the Saudis.
jackup play. Yep.
Yeah, that one's been a little bit of a bummer because I thought you were going to get the $440 million of third-party debt that you were in, as 75 million shares on VAL, just for reference. Like it actually kind of, you're like, oh, man, I'd love to have that money back. You're looking at a $66 stock. You're like, dude, just buy like. It's kind of nice. And there's equity value beyond that. I think what I've heard is the IPO is more likely, over the next 2 years on the Saudi exchange, and a debt refi is just going to come concurrent with that. And that whole thing might be $1 billion of value, or maybe, I don't like, it's going to be a big number. So I think, as time goes on, my gut is to more be in VAL and Noble than it is in Rig, just because the math's more in your favor. And this Rig premium, which some of it I thought was technical and just unnecessary.
Brett Coffrin, founder and lead trainer of Fundamental Edge, barely remembers his first year as a hedge fund analyst. Most of the year was spent in a blind panic. Was his research any good? Was he learning fast enough? What did his PM really want from him? Training on the buy side was non-existent 15 years ago when Brett was a new analyst at Maverick Capital. And he actually got demoted. Then he worked harder, found mentors, and asked for uncomfortable feedback. Eventually, he turned it around, learning by osmosis from the talented people around him, and rose to managing director. But is this the best way to develop talent? Brett doesn't think so, and that's why he founded Fundamental Edge. The Fundamental Edge Analyst Academy provides students with the tools, frameworks, and confidence to excel in any fundamental equity analyst seat in the industry. Lose the panic and fast-track your career on the buy side. Find out more about their next cohort at fundamentedge.com.
Let me ask another question. We've driven deep into the weeds here, but let me ask another question on, like, I think it was July, right? VAL, for those who don't know, Valaris, because of their bankruptcy, there were two kind of stranded new build assets at shipyards that Valaris had call options on, right? And I'm simplifying a little bit, but they had call options on, and these are brand new offshore rigs, 7th generation, super new, like premium assets. And in, I think it was July, management comes out on an earnings call and says, hey, we don't know if we're going to exercise these options or not. We're still assessing. We're not going to do it unless we've got contracts. We're not sure. And the stock was down, like, from memory, 10% in a day. You wrote a letter and published it online the next day that said, what are you guys thinking? Like, you are buying these offshore assets so cheaply. And I don't know how you could not exercise these options. And management eventually got religion and did. So I just want to ask, you can correct any part of that story I said, but I just want to ask, like, what do you think management was thinking when they said, hey, we might not exercise these options? And just after you published that letter, what were you hearing from other bulls around that options, around Valaris, all that type of stuff?
I thought the most likely thing that was going on is management was playing this cutesy game of thinking that they can create uncertainty with the yard to get concessions, i.e., because most of these yards and the options. So a deep water rig today, if you want it, we don't know what it costs. The estimates are somewhere between 1.1 and 1.5 billion, and 5 years to build. If you say go build it, it'll take a lot of time. And these yard options, one was for 110 million, one was for 200. Now, keep in mind, the actual price is much higher because that's the standard menu of stuff. Then you have to do all the upgrades right away because people want the first person in contracts is going to want all these special things. Maybe you need to tweak this, that. It's another like 50 million or 75 million bucks of upgrades. And then you got to move the thing, and whether you get mobilization or not, like, let's just call it like add for really silly math, just add $100 million to both. And that's like the all in at your, at first person place. Yeah. So you're all in at 200 to 300. Like, what are you doing? I think what the gist of the letter, the best read of it was it was more than just that. It was every call you hop on with Val, the guy's like Nancy negative. And I get why you need to be Nancy negative. And I kind of wrote it like, dude, you just took the stock. And I think wasn't July. I think it was like March or April or something like that. But like this is cartoonish now. Like if you're playing this game to like pressure the yards and like do this, will they, won't they? I go, it's already gone because there's other people who will buy the rigs. In fact, there have been. So stop with the cutesy game. The worst read of it was they actually weren't going to do it.
I mean, that was my worry. Like the value was so clear, and they were like, too conservative, as you mentioned. Like a lot of these are distressed debt holders, and distressed debt holders are very smart, but they normally have a win by the time it goes to public equity. So they try to play it as conservative as possible. And I was worried they were just like, maybe the options at, I think one of them's 165 and the ship's worth 300. Not good enough. Let's just return that 165 to shareholders or something like that. I was very worried about that.
I mean, look, all there are things going on. Like I was telling Transocean at this point in time, you should do a $2 billion convert and buy every stranded new build. Like, because Transocean at this time, I think the stock was like 6 or 7. And I was like, look, man, and this is one of the things I kind of learned when I was the multi-manager, like talk to some of the pod guys, like, man, when vol's that elevated, these guys are just vol jockeys. Like you can end up with like a cap call structure when you have high vol, and you can make it to you like an up 75, up 100% convert.
Remember the beautiful times of early 2021 where you'd have like Spotify trading at 300. They'd sell a 7-year convert, 0% interest rate that converts at 400, like almost free money. Like a beautiful time. Rick could have been doing that.
Great time. Yeah. So I knew like part of my angst too was like, I know there's private equity, and indeed there have been like a bunch of these rigs have been bought by other people, and Transocean bought the one, but they had the partners, and then they had to swap anyway. But look, there were a lot of layers to that. I was like, look, I can write something, and I went back and forth. What do I do? Because I'm a nobody. But if you write compelling stuff, and that's why the letter, I was like, this is the letter that I can see other people writing, and that was something I picked up through the course of my career, seeing all sides of activism, which is the number of people who can write a letter is actually very small. The number of people who can forward a letter to management and scream at them on behalf of your letter is actually very large. And look, to Val's credit, I got on the phone with them a day later, and there were some other things too. Like I was really annoyed with the debt thing. They were like, we're not going to refi the debt. They needed a revolver. And I was like, this is just monkey. I don't know what math you guys are running. Like you got to clean this thing up. I got on with them, and, it was like the typical activism result, which is you're an idiot, you're wrong. But I'm like, okay, we're on the phone. You can tell me everything that you're disagreeing with. And sure enough, on the next call, much more, I wouldn't say positive. I would say much more realistic commentary. Because I'm not saying be pumpy. I'm just saying like it was cartoonishly negative how they were talking. And to your point, you're creating uncertainty among shareholders when cost of capital is everything, for no reason and no apparent benefit. And if you think you're getting one, you just look foolish. So we got the outcome we wanted. And the letter, to be fair to management as well, it was also really addressed to a lot of the distressed debt guys on the board. Because coming from that world, there is a point of view for some people that there's a right way to run an offshore company. And I'll just say, I don't disagree generally, but the distressed debt people aren't the people who are going to put the highest value on these stocks. And at a certain point, you need to accept the fact that the equity guys that are going to take these stocks to 15 to 20 bucks in the case of Rig, Val, and 150 to 200. It's not a distressed debt guy. It's somebody who's going to say, oil's going higher, day rates are going higher. I want to own this stock. And
I just want to go back to one thing you said earlier that I thought was really insightful. You said, hey, the number of people who can write these letters is small. And look, I mean, yeah, I'm sure there are people who actually aren't good writers. Like obviously being a better writer really helps with this set of stuff. But I think if I could interpret what you mean is a lot of the 2 to 4% holders for a lot of different reasons, they can't write a letter to management, especially a public letter, just lambasting them. Maybe they can get on the phone and be like, hey guys, like, but they can't lambast them. But as you said, they can forward a letter and be like, this guy raises some interesting points. And it's something I've been like really surprised just having a very minor online presence where, you write something and I've had to get a lot less flippant and a lot less, oh, I looked at this for 2 seconds and this company's dumb, because it gets forwarded to management and then the management teams call you. And I was always like, why would people forward? And the answer is exactly what you're saying. I'm a 3% shareholder. I can't burn my relationship with this company. I'm at a bigger organization. My higher ups don't want me to start burning this company, but I can certainly forward Andrew or Judd's letter and say, this guy makes some interesting points. Can you help me address them? So I just thought that was really sharp. And I kind of like that model as you're evolving into it.
Yeah. I mean, look, we can go down this road. Like another big point of leverage that I sort of learned, and this was through the Kano experience. And look, I did 9 podcasts in Kano. I was out of the name. I had a small position, but like I felt obligated, and like, people can see what I've done with Pagaya as well. Like these names, like you advocate, I feel like my name's out there. I feel responsible, even irrespective of how I'm going to trade something, which I have to obviously put myself and my clients first. We like to be proactive. But that aside, with Kano, beyond even the holders, what really came out to me that was really instructive while I was doing all this podcast was the employee reach out. And I think it's a dynamic of activism that's really fascinating, because you look at, like, let's take Facebook. And Facebook was sort of my analog for Pagaya. Like Pagaya, people were like, it's an Israeli fintech. Look, I made a little bit of money. I was up a lot. It's a tough name. It's got an AB share structure. It's an interesting space. Like we can do all this stuff. But most people, 10 years ago, people would say you're out of your mind to even attempt to do anything. And we today, we're doing this on it's Tuesday, right after Martin Luther King. They just announced, I'll say 60% of what I wanted, they announced they were going to do. And what the analog was from Meta's got impossible governance as well. And that stock went from, what was it, the COVID peak, 400 down to $85. And you had like Brad Gerstner, what fund is he at? He's big Silicon Valley.
Altimeter.
He's like on CNBC watching his world blow up. Like, we are writing letters to Mark and all this stuff. What crystallized for Mark, and there's a lot of companies that this is true, more so and less, and also for VAL, 10 years ago, the employees would never even know, like, Carl Icahn was coming after the company. If they did, like, their ability to understand, they would just know, like, Carl, bad, management good, but, like, they couldn't process it. The employees with social media now, if you put out compelling stuff, and I think that's really the key, which is people don't, like, I wasn't successful with VAL because I'm smart. Like, I'm advocating rational stuff. Other people are agreeing, and management is getting growth pressure from investors as well as employees of the company. It's like, hey, okay, you shine a spotlight here. Maybe there's some merit to this stuff, because things should end up where they go. But the employee dynamic, and going back to, sorry, I lost the Met point.
I love it.
When you play your employees with this much stock and you're a talent-based business, Mark ultimately, he pivots from, I'm going to light money on fire with the metaverse to, hey man, a few employees came to me at $85 a share and they're like, I don't want to work here if you're going to pay me 50% in stock.
I had friends who were at Tesla and Uber, right? And now Tesla has been a rocket ship, but I remember, the stock stalled out for a little bit, went down during COVID, and Uber especially. And these are like these are the type of people you want, these are PhDs and name your physics, computers, whatever you want, these are the people you want to hire. And they got vested stock at, let's say, Uber 49 when it went public and it was bull. And, in 2022, the stock's at 30. And I've got friends who are like, hey, I'm probably going to leave because a big piece of my package is RSUs and those are way underwater. And if I go somewhere else, I'll get a new RSU package at that place. And unless Uber turns it around. So I think you're 100% right. Now that is tech companies versus Valaris, where, Valaris, if you're, aside from the upper management, they probably don't have much of an equity culture, whereas Meta, it's running up and down through. But I think it's an astute point.
Yeah, I think just to close the point on it, the biggest thing, if you put out compelling stuff, somebody you are enabling and empowering. You don't know who the people the management's going to listen to. They're not going to listen to you. You're most people who are super successful are like, who's this troll on Twitter? And even if I ran a $10 billion activist fund, how many times has Bill Ackman or Jana or Elliot been told, go pound sand, buddy? because that's most people's first reaction. You're an activist because you totally disagree with what a smart person is doing. They're a smart person because they run the company, and like it's hard to get to these positions anyway. And they don't, you're hoping to catalyze a process where somebody who's adverse to changing can convince themselves through a rationalization that they are still correct, but they're going to do what you want. And you need some person that you don't know who that person is to like get through to them while the stock price is sort of doing it. So, but it all goes back to, you have to be compelling and you have to like feel the situation out. And some of them work, some of them don't. But I think traditional governance protections are in a way almost useless because they have to be responsive. Like nobody wants to really look like an idiot. Stocks have to go up because of stock comp. And, so I think it's interesting.
Let me turn to a different point just on, we just going back to Valaris and Rig, right? So again, it will take longer. They have to roll these contracts, but they are successfully rolling these contracts, right? You're seeing the contracts coming in at 450, 500. They're doing it with oil at 70, 75, not oil at 100. I mean, it took the industry tightening, but people are writing these with oil at 70. Unless oil goes to 55 to 50, I don't think any of that's changing. I guess when people sit here, and I'm biased, I look at Valaris and say like, Judd, what's it going to take for Valaris to start working, right? They are buying back the shares. They are exercising the options. They are realizing the thing. Is this just the sector is so like overlooked? It's not going to do it until all the contracts have rolled and it's just really beating you over the head how cheap these are? Or is there something else that kind of encourages that self-catalyzes this year?
I think you need to see day rate momentum. I think part of what we're
even
working
the 450K isn't enough. It needs to get up to 5.
It's not about an absolute level because the levels are high enough already. Like people should see it. But what we had go on is you had the market start pricing in too high of a day rate momentum trajectory. That did not materialize. Those losses happened. Those people came out. So now we have, a shareholder dislocation. New money has to come in. With VAL, you still have, I think 10, 11% of the things still distressed at guys. With Noble, you still have Maersk owning 20% of the company. So that still has to come out too. From a seasonality perspective, contracting seasons Q1, Q2. And, commodities sort of mixed. I think you need to see the space have a tailwind. The sector beta is usually a bigger deal than the company beta. But I think these things where they are right now, it's really hard for me. If you're correct on the view that offshore CapEx is going to keep going up, that will drive day rates higher. The reason it'll drive day rates higher, I think one of the things that people miss conceptually is day rate ranges beyond just the number are reflecting negotiating dynamics. We're still in what I would call marginal cost discussions. At 450 a day, this isn't about like the phase after marginal cost is percentage of new build economics. Marginal cost discussions, which is where 2 years ago it was, which is where it had been for 5-6 years. It's okay. What does it cost to run this thing? I'll give you $50 more a day. Or nothing more a day. And, so call it 200 a day, 250. And you get more, you get more, you get more. And even at 450 a day, that's not reflective of the capital. Nobody would ever build a new rig at 450 a day.
Well, and if you believe a new rig costs $1 billion, right? What is it? It's $750,000 a day is kind of what you would need to believe, maybe even higher for new build economics.
I think over $1 million a day. But yeah. I think the driving force in this is just classic supply demand. You need offshore CapEx to be high enough to demand enough rigs that there isn't somebody to undercut everybody where they're like, okay, 450 a day, 450 a day. Everybody's like, we're sold out, guys. That's what will get us to 550. And then there's this jump point somewhere between 5 and 650 is a jump point where it stops going linear because all of a sudden you're totally sold out. And the next price isn't from 650. It doesn't go to 7. It goes, and I'm not sure whether it's 650, but there's a number that the pricing curve jumps where the rig guys become self-aware that there aren't enough rigs versus the demand for those rigs. And then they can say 800. And the first time that gets hit or 750 and everybody sees that number, the whole market just reprices step functions higher.
The way you put it on the Twitter space that I just loved, and I tried to get this in, I did a bunch of write-ups on this in January. You go from marginal economics to kind of bidding tension to, you start going from percent of well economics is where you
Yeah,
go,
we've
right?
never been to percent of well. So we've gotten to percent of new build. So after marginal cost, it's like percent of new build. Hey, I'll give you this. I can always build a rig. This cycle, I think it's incredibly likely if it keeps playing out that we go to percent of well. So like because there is no new build, or we'll get new build. And if we stay in the new build percentage new build, you should usually peak where we usually do is slightly above new build economic parity to give you value for the fact that it's still, you know, it used to take 2 years to get a rig. So it'd be like, I'll give you 50% of two, you know, I'll give you 1 extra year of value because that's my indifference point. Like that's how we're going to share it. You theoretically could get to a point with no new build and demand higher where people are like, where should they bid this stuff? I don't know, 25% well IRR.
Let me
And
let
that
me lay
can
it
really get you to higher rates. Now,
the reason you think there's no new build is right now nobody's incentivized, right? Rates are way too low to incentivize new build. But I think the other reason you think there's no new build is, you know, there's questions on technical capabilities, how long it would take to ramp up. But I think a big question is, hey, if a rig's supposed to last 30 years, you know, if you ordered one right now, it wouldn't come for, let's call it 3 years. And then you need to depreciate over 30 years. I think a lot of people would say, I'm not sure if we'll be drilling in 20, 25 years, or I don't know, like the pricing I get for 20 or 25 years on this. So I can't go do it. So the reason you go to percent of well is because, hey, you know, in the past, people have been incentivized to do new builds. Now, if you're questioning the terminal value, you know, it's a sunset industry, but it could be a beautiful sunset is my favorite note on this. And nobody's going to want to build it because they see sunset and they say, hey, in 12 years, this thing might not be running anymore. Am I kind of thinking about that correctly?
I think you are. I would phrase it slightly different, which is it's not going to be a binary, and I'm not presupposing that you were suggesting a binary. You got a fleet of 180 round numbers, okay? How many more rigs at most do you think are going to get built in the next 50 years? Let's assume capital was infinite, like maybe 20 at most. So you think about that, you're like, okay, that's just like 2 more years of additional demand at worst. And the part of it too is there, you know, we talked before about the financial things, which is not $1.5 billion a rig, man. Look at the market cap of these companies. Look at the enterprise. Like who can order 5 more of these things? It's like the whole company. You're just never going to do it.
A common bear point I will get is, hey, I understand none of the shipyards are building these anymore. Nobody wants to build them. I have heard a few people be like, what about China, right? China wants to put out jobs. They want to harvest resources, all this sort of stuff. Like, could you just see China come in and subsidize a bunch of new builds at Chinese shipyards? They would control it. They'd be able to kind of extract resources on their own terms. Does that even enter your consciousness or your worriness?
I think it goes just back to the prior point, which is you can convince yourself if you're a Chinese employment bureaucrat, whatever, that we're going to build Cape-size vessels, Suezmax vessels. We need some VLCCs, the oil tankers, and some LNG tankers and whatnot. But like, if you're going to commit 300,000 people to building something in a shipyard, you kind of want to feel like we need a lot more than 20 of them. So that's where I sort of go back, which is, are you really going to ramp up for 20 rig? Like, you would just need a lot. Like that guy's going to say the social impact, because we already saw this in China and Korea. All the yards in 15, 16, 17, 18 had to lay off. It's like almost 500,000 people lost their job between Korea and China. It's a huge social thing. So the yards are going to have the same long-term contracting requirement effectively that the rig guys are, which is going to put even more pressure on the E&P companies, which is, hey, BP, hey, Exxon, you want me to build all this stuff for you? Like, I need a 20 rig, 10-year commitment. Otherwise, I'm not going to have these people do that. And which just further inhibits new build. But again, like, I actually don't look at these valuations, you don't even have to address any of this. We're trading at like a third of new build economics.
Hey, I'm just asking questions. I've got the expert on. I can ask any question I want. You know, I'm with you. One more question.
Yeah.
So much of the industry, so much of the new tendering has been done by Petrobras, right? How much is there a risk of Brazilian disruption, right? I'm sure Petrobras is doing this because they see great returns and everything, but they're taking a heck of a lot of the tenders. They are the one who are driving a lot of these tenders. You know, name your disruption. Brazil, political turmoil. Petrobras gets a lot more bearish. Petrobras has an internal scandal. Like, how much is there? It sounds crazy to say Petrobras could affect an industry, but if Petrobras wasn't bidding, it would look a lot different to me. How much are you like kind of concerned about that Petrobras risk?
No, I'm not. Like, they don't have an alternative. All their oil's offshore. Oil is destiny. It is the linchpin of their entire economy. to get more. I think where you have to be concerned, I forget what Brazilian production is now. I think it's like, oh God, now I have to look this up because I have the wrong number.
No, it's fine.
It's like 2 or 3 million barrels. Hold on. Brazilian, you can look it up too here. Brazilian oil production. This is a huge point. Hold on. Because I do have a number that this matters. Oil production. Okay. 3 million barrels a day.
Judd Googling stuff. This is the exciting stuff people listen to.
I have too many numbers in the head. It's like you get older too, and then you like remember the wrong numbers and whatnot. And I'm very happy.
Not you. I want anyone who's listening on YouTube, go look at Judd last year and look at him this year. He looks like he's DH 10 years. the shaved head. He's been hitting the gym. Looking good.
That becomes. I think Brazil has to start at 6-7 million a day. I think you have to start asking yourself something like this question. We're at 3, and they can, like, the prisoner's dilemma. Like, this is an issue for the Saudis. Okay, Brazil goes from 3 to 7 million barrels a day. What does that mean for Saudi? What does that mean for Russia? And is this one of the reasons that oil price, like, the real risk is this prisoner's dilemma? You know, you have oh God, now Angola just dropped out of OPEC. They're like 1 million barrels a day. They're also an offshore guy, which is our oil price. You know, the Saudis are. This is. I'll set the table with this. This is we have Middle East conflict. It's a shooting gallery with the Houthis and the Iranians, and oil cannot catch a bid.
I was actually going to ask you this. Like, you know, a year ago, if you'd been like, "Hey, Andrew, like, we're not in a recession. We've got huge turmoil in the Middle East. There's still an ongoing Russia-Ukraine war. What do you think the oil price will be?" Like, I don't know, 90.
Oh, and the Fed pivoted. This is the thing.
Again, no recession.
Like, the U.S. economy is doing great. And I 90, think what it is, and I think this is really the risk. So it's not, it's Angola's going to incentivize to produce. They've told you, we're dropping out of OPEC so we can literally drill and pump as much as we can. Brazil, their destiny is drill, pump, get as much oil out of the ground. And if everybody does this, all of a sudden you just have an abundance of oil. And we're kind of already seeing it. Like, non-OPEC supply continues to be, which, you know, is still U.S. shale predominantly, but like, it's still outperforming. And I think that's the risk, that we just wake up with, in 5 years, that we were really right on offshore. In fact, we were too right. And now you can help this.
I like that your risk is we were really right. We were just too right. I like that.
We were too right. And then all of a sudden we got 110 million of supply barrels per day, and we only have 105 in demand. Like, ouch. That stinks. So we need China to come back on the demand side. Yeah, it's oil price is hard, man. And like, that's why this space is hard. And it goes back to sizing, and you know what, all these things have to be trading sardines. The time that you can buy oil and close your eyes, I think we've had it for this, I'm not going to say decades. It's almost half over.
You do decade, you're back to 2014 when oil was 100 or 110 and people were, yeah.
But like, you had, I mean, the COVID lows in oil. I mean, it's going to kill me the rest of my life. But I looked at the Oxy warrants at 2 and I didn't pull the trigger. And I was partially right because I was so sure I was going to make money in other stuff. And I did. But like, well, I knew that was, anyway. But you could have bought those Oxy warrants at 2 and you're like, it's a 2028 warrant. It's got anti-dilution protection.
Whatever. You know what else is a 2028 warrant that has anti-dilution protection?
Yeah. VAL warrants. VAL warrants are great, but you are taking macro. The point I'm making is you certainly are taking macro risk here. I don't think you're taking a lot. I think it's a very convex bet on offshore. And I think that the totality of data points point to the core call, which was more than Tidewater, as all this offshore stuff's going to work, is correct. And I think we're just not pricing in much.
I do think it is interesting. Like, you know, again, I can't remember what oil was when we talked last year, right? Let's say 80, 70, whatever. Let's say oil is basically flat since last year, which is surprising given everything we listed.
Yeah.
But the notable thing to me is, hey, you know, offshore rig rates have gone up. Like, they've continued the same path we're talking about. And it didn't take oil going ballistic to do it. Like, they did it with oil pretty much flat. That to me speaks actually a lot of the thesis. It's a validation of a lot of
you're long offshore CapEx. That's the call. and we're just waiting for this moment that, it's like, I wish I had the math of like dollars of CapEx equals number of rig demand. I definitely, if I still worked in hedge funds, would have to come up with some fake version of what that all means.
I've tried it. It's really hard. It's really, I mean, obviously all of them.
I'm content in my own world that I know it's going higher, and I get it. I was a little bit wrong on timing that like the cold stacked rigs and the stranded new builds are really, a little bit of a wet blanket on right now. Once we get through those, I'm still convinced that they're like, convinced is the wrong word. I've seen the cycle a million times. Like, I know it's coming. I know there's a step function and all of this. And then I guess we haven't made this point yet. No, I'll do it now, which is there's a fundamental premise with offshore. And this goes to the percentage of well economics, which is the average offshore well, I think even at $65 oil, is like a 150% IRR. Now, the IRRs are so high because you have to build all this associated infrastructure, the platforms, the piping and whatnot. That's billions of dollars of sunk cost. And once you go down that road and that stuff's there, an incremental well isn't that like, and this stuff doesn't deplete that much. It's like very low decline rates, very oil heavy, not a lot of gas. We're even in the Gulf of Mexico. That's another call option that you have this year. Biden has really been terrible for the Gulf of Mexico. We get a Republican, and I don't know who the Republican is, but I'm not touching that. But you talk about catalysts this year. A Republican win is going to moon offshore because that will, the Gulf of Mexico, I think when Transocean blew up, like the Deepwater Horizon thing in 2011 or 2012, we had 55 rigs offshore in the Gulf of Mexico. Now, some of that was what do we have now? Like 12? I forget the number. People can look it up. It's not many. I think that's the other surprise for this cycle, and this is sort of the other side of the Petrobras thing, which is West Africa's come back, Namibia, whatever, the country with an
I know.
Right next to South Africa, that was historically part of South Africa, but colonial South Africa. There's a lot of demand in Africa, part of the Golden Triangle. The Gulf of Mexico has not come back at all. And you get a Republican administration, you're going to see a lot. You have Mexico doing what they're doing in Altamira.
Let me ask you, Gulf of Mexico. So I hear you. I mean, look, I've seen politics. I know drill. Every Republican presidential candidate is coming out and saying that. And obviously the executive branch has a lot of discretion towards drill in the Gulf of Mexico. I do wonder, like, hey, the Gulf of Mexico, those are big investments. Specifically, you're going really deep into the Gulf of Mexico, right? So I hear you, a Republican's going to be okay with, or Republican's going to really encourage it. But if I'm Shell, name your company, do I want to go invest hundreds of millions of dollars into drilling in the Gulf of Mexico when I've got this much political volatility, right? Because I know Talos Energy feels like they announced it yesterday. I haven't really investigated, but I know they feel like the administration is improperly holding approval of leases from them. And if I'm Shell, I'm like, hey, okay, cool. I've got a Republican in here who's letting me drill in the Gulf of Mexico now. 4 years from now, I might have sunk in $8 million and now I'm getting hit with taxes I didn't see, or all of my permits are not coming back returned because there's a new administration. Do you think there's like that type of political risk where, stability would be great?
It's just a scale. Yeah. Like what I'm saying, like all I'm saying is you get Republicans and it's not hard to say we might have a net demand of 5-6 rigs in the Gulf of Mexico. And we're so close to that point with only 180 rigs, deep water. Man, you had 5 where there isn't 5. Like, that could have 100 a day impact just on the supply demand because it's not there. That's what I'm saying. I agree. But what we haven't, the pushback to that too, why I'm saying 5 or maybe 10 is I'm sure the oil industry is going to be very keen to all this stuff. So they'll put new language in. If you get like a sweep like you had with Trump in 2016, where the Republicans control the House, the Senate, and the White House, they'll do just what the Democrats do with other stuff. Like, okay, let's lock this up so that like it would be hard to unwind.
No, I definitely hear you. I do think, I just worry, like, when you've got something this politicized, and I look at something like, I'm no expert, but the MVP pipe or whatever, when it gets this politicized and it's hard to make a 20-year commitment when every 4 years things can change this much, and I do hear you on the lockup. I just worry that, but look, I don't think that it'd be great if we got it. I don't think it impacts the thesis.
I don't think you need it. It'd just be, I'm just pointing out from a trading dynamic. It's certainly that is one thing in an election year. Like, not much of what I own is like politically sensitive. I mean, there's just also like, look, even more basic, like Republicans win, buy defense contractors, buy energy.
Like all the best investors, Fundamental Edge believes that the learning process never truly ends. That's why the Analyst Academy is just the beginning of their journey with you. Fundamental Edge alumni gain access to exclusive content, such as their guest speaker series. It recently featured TED CDs of capital allocators. Alumni can also look forward to frequent webinars, case studies, and content from industry partners. For job seekers, there's the Talent Hub, which helps both Academy graduates and other buy-side candidates connect with top funds looking to add new analysts. Alumni, including students enrolled in the upcoming January cohort, are also invited to the inaugural Analyst Spring Training Conference coming up this spring in Scottsdale, Arizona. Attendees will engage in numerous learning sessions while building their buy-side networks, and then they'll enjoy some spring league baseball and the amazing Arizona weather. If you'd like access to all that Fundamental Edge has to offer your career, visit fundamentedge.com for more information about the next Academy cohort. That's fundamentedge.com.
Well, you say that. I mean, if they're going to drill, you might want to sell energy, because historically, drill has actually been bad for energy.
At these valuations.
Offshore, hey, I have plenty of energy exposure. And what we're talking about is equipment providers, and you generally want to buy equipment providers in drill. Yeah. We have been rambling for a long time, which I think is indicative I need to have you on more than once a year. But let me just quickly ask you, you've done several Suggestivist letters. Your most recent was Farm. We mentioned PGY. We mentioned a few others. What are you really focused on these days? Is it Farm? Are there other things you're kind of focused on right now?
I think at a very big level, like, this has been a journey for me. I left hedge funds at the start of 2020. I've been with my team. We launched a fund at Neuberger Berman with basically the same strategy we had at the pod shop. So like, that whole experience was 7 years. I did 8+ years in distressed debt. I had no idea what the heck I was going to do. And at the start of 2020, and then COVID happened. And it's been me sort of like figuring out. I wasn't even on Twitter until 2021. I had like one of my clients, the consulting side, was like, you should be on Twitter. I was like, okay.
And look at the friendships, Judd. Look at the friendships.
It's great. And I think I've always been involved in activism because that's just the nature of event-driven. And I think the success, the outcome success of the VAL letter, that tweet had 160,000 impressions on it in a week, and I'm on with the company right away. Like, look, I'd like to. I'm occasionally a kind of an arrogant guy. Like, did my wildest dreams that I think it would have that immediate of a response and an impact? No. Had it been something that had been pestering in my mind for more than a decade of like, man, there's like this window that I think I can exploit? Yes. And, look, a lot of my clients traffic in smaller stuff. And then you see sort of this other piece, which is, I think we're kind of, one of the things going on is like, we're in this like pseudo Peter Lynch era. Peter Lynch was taking over. He started the 80s. There were 11,000 public companies. Now I think there's 6,000 or 7,000. It's not a lot. That might even be high. I don't know. Maybe we get the Russell 3000.
High, yeah.
But the COVID class, if you want to call it, we haven't had this many unfollowed, underfollowed, small and mid cap stocks. And to sort of go even more big picture, like the first fund I joined in 2005 was $5.5 billion when I joined at the end of 2005. It's $20 billion when I left in 2011. And I worked in some really big places. And I remember like the $5.5 billion fund, it became an issue by 2007. Hey, some of the stuff we used to do, we can't do anymore because it just thought like the return on time doesn't make sense. And when I went to the pod shop, I was really exposed more to like, I had to think about portfolio management questions a lot more than I ever had. And one of the things that I really picked up on, the best guys there ran businesses. They weren't PMs. And so from a business perspective, they're like, there's this set of trades. The P&L TAM is this. I'm going to dedicate this many people, this much time, and I'm going to capture all of it. If there's positive returns, I'm at a place where I can hire more people, I can do this. And I don't care that if I ran a $5 billion fund, that this wouldn't make sense. I run a pod that I have to put up 120 million of P&L a year, finding a business that I can dedicate 2 junior guys to and make 20 million P&L with a standard deviation of 5 million a year. Like, I'm going to do that all day. And then you find more and more pieces of this. So I look sort of at the small cap thing, and there's also a humility to it too, which is, I think one of the sharpest things that the guy I worked for at the pod shop and Neuberger said, he's like, look, we have to be demonstrably better on things than the guys on the other side of the floor with the long short guys. Like, our bar there has to be the event process path has to dwarf the quarterly earnings volatility. The guys on the other side of the floor who know the company better can earn, like, we have to overcome that. And that's kind of the bar. And so I'm like, a lot of what I do, like in energy, obviously I feel comfortable, not super comfortable, but I feel comfortable that I'm not going to like meet a guy at Millennium who's going to tell me something dramatically that I don't know about Tidewater. There's not many names that I can realistically look in the mirror and say that about. So I need to either avoid that conflict with those people by looking in areas that don't make sense for them economically, that make sense for me. I need to get smarter on things that I can, figure it out, or I need to have enough event noise that they're freaked out in their confidence interval and I can like find a way to like price it better. So all of that stuff sort of comes together. And then the progression of, okay, we put the VAL letter out that we're, Kano, I made a little bit, I lost a ton on CareMax. That whole value-based care thing ended up being terrible. Although all of that helped my conviction on TOI, the Oncology Institute, because it really helped crystallize for me. I was like, oh, I finally found like the right place in value-based care. You just don't want to take MLR risk. But where I'm going is I see this like with farm. Look, my only thing with farm, other than look, I like the stock. I think that I'm going to buy this today versus not, is I think they're going to beat earnings. And I think the event guys who've been in it since 2020 are like tired and exhausted. They've all lost money and that's why they're selling. I think they're going to beat, and I think I can bring eyes to the name by highlighting it because it's underfollowed. Okay, you know what? There's a lot of names like that, and you can take that positively, negatively. You can say like, one guy on Twitter was like, "You're besmudging your pedigree" or something. Like, let me tell you,
I don't even know what that means.
I'm 42. I got a 5.5-year-old kid. I got a woman who's amazing. We never got married. I have a little bit of, she's an amazing mom. We get along at 95% of parenting decisions, which most married people.
Pedigree sounds like you're like part of the royal family. And it's like, hey, there's 700 years of history here, and you're besmudging the history by, going activist on small caps. Anyway,
I don't care. I mean, my goals in life are, I want to have fun. I want to be intellectually challenged. A great realization I had a couple years ago, which is different from in my 20s. I was like, I'm going to retire by 35. And you get older, you keep doing it. And some people leave this industry. Me, I had the realization. I look at my dad who's going to work to the day he dies. And for him, it's not work. He loves it. And especially with the kid, I look at like what interests me. I love it. And the realization that I'm going to do this in some version for the rest of my life, and that the process is the end. That is the victory. And so then you become like, how do I construct a way to do this in a way that's sustainable, intellectually and stress, which basically is you can't be a pot shop guy because there's no way you can call quarters for 30 years. And then it evolves. You see stuff and you go for it. So I'm going to be all over the map. I see a place that I can create value that makes sense to me. And I'm going to pursue that. I'd love to find stuff that's super scalable that like a $20 billion fund could put $2 billion into. But I think there's an arrogance to assume that I could even do that. And I may be wrong in a lot of the small cap stuff. And look, my results have been all over the board. Yeah.
Just on the small cap stuff. I mean, to me, what you're doing is you're taking like concentrated bets on things. I don't want to say high variance, but high variance. Like, I've followed you for a while. I know, hey, if Judd's pitching name, there's a decent chance it's down 80% over the next year, or there's a decent chance it's a 3-bagger. And like, you can slugging percentage average that out, and that works really well. But I think you're like finding things that have hair on them. Tidewater had less hair than most, but there was certainly a version to it. But I think you're finding things that have hair on them, that have high variance outcome. And, it's one of the things I push myself on. Like, I keep looking and be like, hey, Andrew, you have a position in this thing that's like a compounder that you think is going to grow earnings. It trades at 8 times free cash flow, and you think it's going to grow earnings 5 to 8%. Like, that's great. But are you really going to generate like alpha there without an event, without some hair, without a controversial opinion? And what you're leading into is like, ZimV, hey, for sale spinoff. I mean, I looked at that 4 times and they blew that up, and like you made a killing on that. Or there are some that you haven't made a killing on, but you average it out and hopefully it works.
Yeah, the realization that I'm going to get a lot wrong and being mentally okay with it, that I don't actually know. I know that I'm dancing. It may just be incorrect approach, but like at this age, not that I'm like a curmudgeon about it, but like you can only be the man that you are. And this is where I like to travel. This is what interests me. And I get that sometimes I'm dancing around this line. And sometimes the right side of that line, when I call it right with the ZimB, and like ZimB, we got tested, man. I got in that thing at 550.
I remember. Yeah.
Came down to 7, and then like they did what I thought, and we get 18. But like, and I think that stock too still works up to like north of 30. But like, that's possible, and it's just as possible for me to be right on Kano out of the gate and then wrong in the end. And I got out. CareMax, I was just totally wrong. Catapult was one of the worst. Oh God, what an idiot I was! I just got married to the wrong one.
Yeah, like, you and me both there.
But like, I think one of the fair criticisms that a lot of people around me have given me is, because I get too attached to names, and part of that is a legacy of being a senior analyst at a senior PM fund, where you only have so many at bats a year. You feel like to convince the billionaire, you have to really, really believe. And now I have the ability to just find another thing. And like, feedback I always got when I was down and I lost money, and I've had a lot of ups and downs in life, people have been like, dude, you always find names that go up 5x. So you don't need to be as concentrated. There's always going to be another name. And like with Pagaya, look, I'm like very happy that like I was able to mentally pivot as I did. And I had a lesson that I've learned many times, which is, hey, I feel a need to reach out to management, because it didn't start as an activist thing. Like, I highlighted things in the initial memo that I wrote in July, like you need to do all this stuff differently, but it was really just basically an orphan capital markets trade. Nobody owns it, nobody realizes it and whatnot. And it sort of became something where I felt the need to reach out. And I ultimately wrote an activist letter. And the answer, when you go into things not as an activist, when you want to be an activist, the answer is usually you should just sell. And being aware of that, I put it on the short fuse. I knew it was going to be hard.
You said that, and I got an instant headache, because every time I've been like, I need to go activist on this thing, I would have saved myself so much heartbreak and so much L in the P&L by just being like, move on. You don't own 5% of this company. Go to the next one. It's time to move on. You're just very insightful.
Yeah. And look, the first year that I sold it ran up after the letter to like 170. I sold a bunch because Flame, the Jim Flores SPAC, and the thing is at $12. I'm pretty sure it's going to get approved. I don't know if it is like that. Those warrants could be zero. I saw those warrants there, and I'm like, I got cash. I bought the warrants I could. I was like, the guy is at 160. I can buy these warrants at like 110. I really am. I think the warrants might have a better risk reward. I was like, I could take off a bunch of a bunch of Pagaya. And I think a new mental lesson that I need to do, because it really catalyzed for me. Your body tells you stuff. I'm old enough that I need to listen to my body more, and I'm good at picking up signals. And man, you sell 10, 15% and you're like, this feels good. And I kind of already was there, because I knew when I was writing the letter, like low probability, I was like, let's see what response we get. I can bring a spotlight to this company, and somebody can get through to this Israeli guy. That's all I was hoping. And like, I thought it would be the employees, but I did that. I sold, and I'm like, and then after you sell a little bit, you've already gone down the road where it's like,
funny how you sell a little and it's a lot easier to sell the rest.
Sell a lot more. And then you just like, look, we're talking about this today on a Tuesday. They just announced, 67% of what I wanted. Stock's up. I don't know what it's up now since we've been talking, but it's like 20%, but it's like well below my average exit price. And people this morning were like, how do you feel? Like, I feel like how I felt a week and a half ago when I was largely out, which is I'm going to find 5 more things. It's January. I don't need to win this game. I can win plenty of other games. I'm in a game against make my clients happy, make me happy, make money, pay for my kid, live a happy life. I'll find another one.
I like it. Well, hey, Judd, this has been great. Unfortunately, I know you're hitting the gym nonstop. I used to, but I got some physical therapy I've got to run to, because I've rambled for a long time. I really enjoyed it.
This was great. Thank you so much for having me on. I hope everybody enjoyed it.
Yep. Yeah. We're just going to have you on before a year this time, but this has been great. I mean, the offshore thesis is great, everything else. And as you know, I really love the suggestivism angle you're going, and just want to keep encouraging you to do it, and maybe do it on some companies that I'm long as well.
We're welcoming all ideas from people. I get a lot of ideas from the network. So if something I want to look at, I will throw this out there too. One of my, I do goals at the start of every year. My goal for this year, one of them, I don't know if it's going to happen, is I want to raise an SPV for a suggestivism thing. I don't know whether I'm going to do it, but I'm very scarred from my hedge fund experience. I did like 300 IR meetings raising a fund. But
We'll talk about that separately. I'll remember everyone because we talked about so much different stuff. Just go consult the disclaimer at the front of the podcast. Judd did one. I did one. I always include one at the back half of the podcast too. None of this investment advice. This consult that. But Judd Arnold, this has been great, and we will have you back on in the near future.
Thanks so much.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.